Welcome back to Kitco Mining. I'm Jeremy Szafron. Well, gold prices have hit a record high once again, almost approaching $2,800 an ounce. And silver, of course, is seeing increased demand from industrial investor sources, which means the metal sector is gaining renewed attention. Now, central banks, particularly in Asia, are driving consistent gold demand as part of a broader reserve diversification strategy, which has, of course, helped support prices even as global economic concerns persist. However, mining stocks have been held back by rising production costs, with all-in sustaining costs up 50% since 2020 at companies like Newmont, driven by inflation in energy, labor, and materials. Meanwhile, the U.S. election is presenting miners with two vastly different paths. A Harris administration could lead to stricter environmental regulations, increasing operational costs for domestic miners potentially. And in contrast, Trump's platform promises to prioritize domestic production and resource independence, potentially easing regulatory pressures and, of course, spurring investment in U.S.-based mining projects. Today, we're joined by John Ciampaglia. He is, of course, the CEO of Sprott Asset Management. He's got a unique perspective on how these dynamics could impact mining stocks. Last time he was on, we discussed Sprott's strategic outlook for precious metals and their approach to navigating market volatility. John, welcome back to Kitco. Great to have you.
Yeah, great to be back. Thank you.
Okay, let's bust into that off the top. I mentioned in my intro that Newmont, of course, had just posted some really solid earnings, but their stock dropped 15% after reporting because of higher costs. It's a trend we're seeing across the sector as production costs rise. For Sprott, I'm curious when looking at mining investments, how much do you weigh factors like these all-in sustaining costs versus other metrics?
Yeah, it's hugely important. If you think about the rationale for investing in some of these mining equities relative to just investing in the physical itself, you want to capture that upside potential through that operating leverage and optionality. And when, one of the world's biggest gold miners signals that their cost inflation is still an ongoing issue, and there's that margin compression, you're just not getting that operating leverage you're trying to achieve. So it was a bit of a surprise for us, and it was definitely disappointing to the sector. I think a lot of market participants were hopeful that this persistent cost inflation we've seen, which, as you mentioned, really covers a lot of input costs, but in particularly labor costs, was abating. And finally, as the price of the metal hit all-time highs, a lot of those price gains were going to fall to the bottom line. And it appears as though we're not quite there yet. And I think that's why the stock, sold off as much as it did.
Yeah, it's quite fascinating, as you mentioned, to watch. Okay, well, with AISCs or these imploding costs on that side, being up over 50% since 2020, in some companies, are low-cost projects still a top priority for Sprott, or factors like scalability and reserve quality becoming more and more important as these costs continue to climb?
Yeah, obviously it's a case-by-case basis, really trying to find high value assets at reasonable prices. And the market obviously will place a premium on those projects that, have high quality and obviously are in safe jurisdictions. I think geopolitical risks are becoming, unfortunately, a bigger issue in resource investing. We've seen a rise in resource nationalism across a number of countries the last few years. And this is, governments eyeing the value of the pie getting bigger. As these commodity prices come back to life, and they're all kind of looking on the sidelines saying, hey, how do we get a bigger piece of that? So, I think jurisdictional risks are becoming more top of mind. We've obviously had some mines in different sectors basically close because of government actions or removing permits. And I think this is becoming top of mind as well, because, it doesn't matter what the price of the resource is or how good the deposit is. If the mine is shut down by government action, there's obviously no value there, or very little value. So that's another thing we're paying a lot more close attention to.
Yeah, well said. The geopolitical situation. We'll get a little bit into that. I want to get your take on why we're seeing multiple gold highs this year. Gold's been up 33% year to date. There was a time where I'd come on and we'd broadcast these breaking records. It's multiple times this year. John, you've been doing this a long time. Anything surprising you here? You must be surprised.
Yeah, well, if I think back to where we were last October, we were kind of spinning our wheels in the doldrums at $1,800. And everybody, including ourselves, was very frustrated by the price action because, we just thought the fundamentals were a lot more supportive of higher gold prices, after hitting all-time highs a few years earlier. But what's really interesting to us is this price has rallied like almost $1,000 an ounce since October. And it seems as though there's large pockets of the market that are kind of not even paying attention. Yeah. And that to us is quite bullish. If you think about the different market segments, it's only been in the last couple of months we've seen inflows return into gold ETFs globally. And that's amazing because, it's not like they were pushing the price to these new highs other than, the last couple of months. Futures positioning in the gold market is something we look at as another sign of institutional interest in the category. We've clearly seen a rotation away from a lot of, let's call it, economically sensitive metals like copper and iron, metals more tied to China, and they've been rotating into precious metals. That's another bullish sign, albeit in the paper markets. And then central banks, as you mentioned, have been really big buyers of gold. But in the last few months, China has very openly declared that it hasn't bought gold for 3 months. And we think this is a classic case of them trying to talk the market down, and that the longer term picture is further accumulation of gold. They clearly have a strategic objective here to move away from US dollars and treasuries as part of their foreign exchange mix. And favoring US dollars. We think a number of other BRIC countries are clearly following in the footsteps. And that central bank buying, while it may ebb and flow month to month, we think the net change is to add ounces to reserves.
Yeah. I always take it with a grain of salt when the Chinese come out with any economic data, let alone, what their central bank is doing. Okay, I want to get back into on the metal side, because, given the high metal prices that we're seeing, M&A has been favored by miners as an alternative to launching new expensive projects, obviously. Do you see this consolidation trend as a sustainable approach, or could it lead to overpaying if market conditions change here?
Yeah, it's a great question. And I think management teams have been incredibly disciplined in terms of not repeating some of the sins of the past. Mm-hmm. At the end of the last cycle, mining companies were really incentivized to add ounces, in many cases, lower grade deposits in some jurisdictions that were riskier because it was all about quantity over quality. I think the shareholders have really demanded a different approach, and that acquisitions that we've seen the last few years are really focused on synergies, whether that's diversifying by region or cost synergies. So the deals seem to be a lot more strategic in nature. The prices paid seem to be more reasonable. A lot of mergers of equals, which doesn't get investors excited on day one. But if you can capitalize on those synergies, the benefits fall to the bottom line over time. We've also seen in other commodity markets where incentive pricing is good for existing mines, but not high enough to build new mines. And I think this is most common, let's say, in the copper market, where we've seen a number of both friendly and more recently hostile takeover attempts in the last 2 years, because I think the big mining companies see how important copper is going to be in the future because of electrification, growing electricity demand, clean energy technologies, et cetera. And they're very focused on increasing their exposure to copper. Now, at $4 and let's say 25 cents a pound, nobody's getting too excited about spending $10 billion on the next copper mine, but they're very excited about trying to buy competitors to acquire those assets, whether they're currently producing assets or development projects, because they view it as a very strong strategy in the short term to increase their exposure to copper. As the price of copper, we think, achieves $5 and $6 a pound pricing, I think you're going to see a lot more projects being announced in terms of greenfield production, which the market needs to address future deficits that are anticipated.
Yeah, it's so interesting. You talk to some of the juniors and even the larger cap stocks when it comes to the mining community, and I think a lot of people thought that their equity prices would, give them a currency where they could go to the market and really do some serious M&A, but it hasn't quite caught up. So are we just at the beginning of this M&A phase, or where are we in it?
Yeah, I think it's going to be more of a slow and steady approach, excuse me, which is what we've seen the last few years. There's been a lot of hype about it, but I think, as I said earlier, companies still have a lot of scar tissue as well as institutional investors around some of the deals that were done in the last cycle. And so people are treading a lot more cautiously. That doesn't mean we won't see more. I think certain assets that are very high caliber are going to be sought after by the majors as they're trying to replace reserves. So those, I think, are more probable takeover targets. But I think they have to be sensible deals. There have to be synergies there. The reality is a lot of these projects need a lot of capital. And in many cases, it's going to be the bigger companies that have the access to capital and also the knowledge to build these mines, and going back to an earlier comment, labor, trying to find skilled labor is a real challenge in this market. And so if you think about having to, hire hundreds of miners to build a new mine or construction workers, it is challenging. And that's what's caused a lot of this cost inflation.
Yeah, I'm curious, obviously we know commodities is very cyclical, and we've seen these rising demands for critical minerals like copper, even lithium. We've been seeing some new investment into the lithium space, which almost seemed to, see the sky there for a moment. Is it the bottom? Are these coming back? What's your outlook?
Yeah, clearly lithium went on a wild roller coaster ride. We had a severe shortage of lithium a couple years ago, which led the price to increase substantially. I don't think anybody thought those prices were sustainable. It was more of a short-term market squeeze in terms of having a shortage against the backdrop of EV sales that were growing around 30% at the time. Clearly, new projects have come online. China has clearly been part of the reason why the lithium price has corrected as much as it has. It's not afraid to produce at a loss lithium. And some of those deposits are starting to come down in terms of production as the price, has fallen substantially. It feels like the lithium price has found a bottom here. It seems to be building a base. EV sales have clearly slowed, but what we're seeing is more plug-in hybrid vehicle sales pick up in many markets, including the United States. Even in China, they are starting to overtake traditional fully electric cars. So plug-in hybrids are starting to take more market share away from straight electric cars. And so we continue to see good, I would say, lithium demand going out in the next few years. And we've obviously seen some projects put on hold as there's a supply imbalance. Lithium is a nascent industry. We really didn't need all this lithium even 5 years ago. Nobody really had electric cars other than a few people in the world. But if you look at China, for example, over 50% of all new auto sales are now categorized as a new energy vehicle. So that could be fully electric, plug-in hybrid, or hybrid. And all of these things require lithium. So demand for lithium is going up. We had a bit of an imbalance between supply and demand, which is starting to correct itself, which commodity markets are very good at sorting themselves out. And it feels as though there's a bit of a bottom here. But there's still some big transactions going on. The Department of Energy just approved a very large loan guarantee for Lithium America, and General Motors also is making an investment in that company. So investments are still happening because people are looking past the short-term correction and supply surplus, and they're looking at the longer-term demand story and saying, if we don't make these investments now, we're not going to have a secure supply chain. And the U.S. is very focused on reshoring some of these critical material supply chains, back to home soil. I would say copper and uranium and lithium and cobalt are 4 metals that the Department of Energy, the Department of Defense have openly acknowledged they need to secure local supplies of these critical minerals.
Yeah, lots of talk too about the uranium side of things too, almost for another conversation. I want to come back here, John, about these geopolitical risks that we just talked about, especially in resource-rich regions. It's almost affected investor confidence across the board. So how does Sprott evaluate jurisdictional risk? And have any global events really shifted your focus towards projects in stable regions or even more U.S.-based assets?
Yeah, we basically have a geopolitical risk heat map that we score countries around the world that are, key mining regions. And every year our team analyzes, some of this is art and science in terms of the perceived risks. Obviously, this is about changes to mining laws, royalty and tax regimes. So we try to factor all of those things into the projects to basically assign risk ratings to these areas. I think it's fair to say that the net risks in many countries have gone up the last few years. Some of that has been political instability in the countries themselves, like places like Niger. They've been in a state of basically an interim government following a coup over a year ago. So uranium mining there has come to a halt. Other countries in Africa as well have had heightened risks. But then on the flip side, you've got more developed markets that have largely ignored mining for the last few years, starting to say, hey, these are critical minerals that we need to support, whether that's mine permitting or loans, guarantees. And so in jurisdictions like Canada and the US, thankfully, which have rich mineral endowments, governments seem to, let's say talking anyways, seem to be signaling that they're going to be much more supportive in this effort to diversify away from China, which we know controls most of the copper supply chain, most of the lithium, supply chain, et cetera. I think governments are very sensitive about this. And then lastly, it was just a few weeks ago that Putin basically, signaled to his government that he wanted a review of retaliatory action against all the sanctions being placed on them. And he specifically called out restricting exports of things like titanium, nickel, and uranium. And if that were to happen, obviously some of those markets are very tight right now. Some of those markets Russia's a key player in. I'd also throw palladium in there. The last few days, palladium has gone on a bit of a run because the G7 countries are trying to advocate to basically boycott Russian palladium. That's got the palladium market going. When the palladium market goes, it usually pulls the platinum market with it. So we've seen at Sprott quite a bit of renewed interest in both platinum and palladium in the last couple of weeks. So yeah, geopolitical risks, I think, unfortunately, are becoming more front and center. And then in a week from now, we've got the U.S. election, and people are I think mostly sitting on the sidelines. We don't think it's going to be a big game changer either way, but I think there's just a little bit of sitting on your hands on the sidelines to see how this all plays out. One interesting announcement that was made as part of the Harris campaign was this idea of establishing stockpiles of critical materials, which kind of caught our attention, because in the past, the U.S. was always like the Strategic Petroleum Reserve. They always held large reserves of different materials that they deemed to be of national security, whether it was metals for alloys for defense industries or what have you. And it was interesting that this was called out in the as part of the campaign program. Uranium is one that's been talked about. Should the U.S. be building up a strategic uranium stockpile because it is completely dependent on other countries for most of its uranium needs? Obviously, copper is another key material that it's dependent on, and lithium is an industry that's basically starting to grow in the U.S., but is still a couple years away. So yeah, it's been a very interesting, somewhat volatile year in metals, and geopolitics seems to be having a disproportionate impact on these markets.
Yeah, John, you were talking a little bit about China before we get into the election side of things. And I mean, the Asian central banks, of course, including China, are sustaining really strong demand for gold, which has been a key driver in supporting prices. But then we see what's happening with BRICS. I guess my question is, do you expect this central bank demand to continue? And could we see Western central banks like the Fed take a similar approach in the coming years?
Yeah, I wish they would. I mean, Western central banks, with the exception of a few countries, seem to be still stuck in the past in terms of owning very low amounts of gold, or, in the case of Canada, where I live, no gold, sadly. But you do see some countries. It's not just China. You see Turkey, Singapore, Poland, India. I mean, all these central banks keep adding to the reserves, for different reasons. I think people are thinking very differently about foreign assets after the amount of assets that were seized and frozen by the G7. Russian assets after the war broke out in the Ukraine. So I think governments are thinking very differently about securing assets on home soil. Gold is obviously has incredible value to it, so it's easy to store and diversify away from foreign exchange or foreign assets. So I do think, irrespective of China's announcements that it stopped buying gold, I think the trend is for central banks to buy more. And central banks are less sensitive to the price. I mean, maybe the Chinese are, and maybe they're not. But central banks, I think, have a very specific policy goal in place, and they're going to fulfill that goal irrespective of the gold price. I don't think they're there to time the market. I think they have very specific goals around accumulation of gold. And I think that will provide a steady bid to the market. That's something that we think has been one of the key reasons why the gold price has gone up so much in the last 12 months. It's not been retail investors. It's only been institutional investors for the last 2 months out of 12. And central banks have been more of that steady bid in the market.
Yeah, fascinating. Okay, well, obviously, we're getting ready for, on the Kitco news side, the U.S. election. It's fast approaching, and Harris and Trump are proposing very different policies that could impact mining. I mean, Harris supports stricter environmental standards, likely raising costs for domestic miners, while Trump favors resource independence and, could ease these regulatory burdens. You just mentioned the Harris campaign coming out and saying, okay, we need to get ahead of these defense metals, almost like China has. But how closely are you watching, policy here when it comes to your investments, and how is it going to shape the U.S. mining sector going forward?
Yeah, well, I think the U.S. mining sector and the Canadian mining sector are coming back into focus for the first time in a long time. And so you might, obviously we're a bit skeptical, and you have to question whether these are just photo ops opportunities. But I actually think there's more to it. I think they've really realized how important critical minerals are for many of these bigger picture policy goals, whether they're decarbonization driven or whether they are simply to add more electricity into the grid, which is increasingly under growing stress. I think they realize that they're very metal dependent. And so this is why governments are actually talking about this. It's not just metals, it's everything. It's about reforming and streamlining the process to build nuclear power stations. The same goes for building high voltage electrical lines. So all of these things are very mineral intensive. And the fact that they're at least acknowledging that they're part of the problem is the first step. And obviously it takes time, but there are lots of interesting pieces of legislation that are becoming law, particularly in the US, that is really signaling that they're becoming much more mineral intensive. Mm-hmm. And again, it doesn't happen overnight because these are long lead projects, but I think all signs point to greater emphasis on mining. And like I said, they're starting to realize that they're very dependent on other nations for many of these critical material supply chains, and it's almost become a national security issue. Mm-hmm. And when it becomes a national security issue, it's amazing how bipartisan support rallies around that.
Yeah, well said. I mean, we're getting down a rabbit hole, but I have to ask, because I was reading the Canadian news, obviously a large jurisdiction as well. There's a possibility of an election coming up at some point. What happens if that takes place in Canada as well? I mean, it seems like Canada is a little bit behind here.
I agree. I mean, we have incredible mineral endowments here. And if you think about the wealth creation effect, and if you think about the premium that people will place on our minerals because they're in safe jurisdictions, they are subject today to very high environmental standards, labor standards, and obviously relationships with First Nations where many of these mineral endowments reside. Canada has a very good track record, and we definitely see when a premium being placed on being able to source materials responsibly from low risk jurisdictions. I think Canada has all the right components to be a big winner here. And obviously the US legislation is being drafted in many cases so that minerals from allied countries or countries with free trade agreements like we have with the US also qualify for a lot of these tax credits. So I think Canada is wonderfully positioned. We obviously need the political will here, and we need investor capital, which has been one of the big missing links for the mining sector. we have all the components here. We just have to pull it together. But I think Canada is very well positioned here going forward.
Yeah, it sounds like you're pretty bullish on going forward on these U.S.-based projects as well. I mean, it seems like the macro environment is starting to open up. People realize we can't just turn to solar tomorrow.
Yeah, absolutely. I think people are starting to realize that our energy security is a bigger priority. Our grids are old and need more investment, and that it's not all about one solution. We need kind of all of it. And so you often hear this term energy transition as a way to kind of signal a move from fossil fuel heavy energy systems to cleaner forms. And that's going to continue, but it's really about energy addition. The grid is clearly in need of more power. And if it can be clean, that's a bonus. You heard it just recently from the Minister of Energy for Ontario saying how much more electricity Ontario is going to need. And Ontario is a great case study in that over 50% of our electricity comes from nuclear power. And that is a real, when I go to conferences, we get put up as a case study in many of these conferences that I go to around the country that made a different policy decision many years ago around refurbishing the plants we had and investing in them. And now we've got a very clean and stable grid that many countries are trying to achieve. And as we've seen in some countries, trying to run a highly industrialized economy on the back of a variable intermittent renewable energy is just not going to work. It's just impossible. So you can have some degree of renewable energy on your grid, but until we have a solution for large scale grid power backup, battery power storage, you're going to need other sources to offset intermittency. And that's where, baseload power is very important, which is what nuclear power provides. And then you've got other technologies that are, cleaner and more reliable than, let's say, more traditional coal, which, the world is trying to wean off, with the exception of places like India and China. They continue to build more coal because they just need more electricity.
Yeah. Are you watching SMRs at all here? I mean, it's a fascinating trend. Could get us out of some trouble.
Yeah, this has been a really fascinating area of development, particularly in the last few weeks, and it's because a number of very big tech companies who have very ambitious goals related to artificial intelligence need a lot of electricity and clean electricity to power these AI data centers. So just for some perspective, these AI data centers are basically supercomputers, and they require up to 10 times the amount of electricity than a traditional data center that you would use, for a Google search or whatever. And so they're trying to figure out, how do we secure reliable power that's clean, because they have these low carbon goals. And they are signing deals with small modular reactor companies to build new capacity for them. In many cases, these small modular reactors are going to be co-located next to these AI data centers, so that you basically, pump the electricity right into the data center. You don't need to build a lot of complicated and cumbersome, new transmission lines, which gets bogged down in a lot of lawsuits and protests and whatnot. And so we've seen big announcements from Microsoft and Oracle and Google and Amazon. And it really does a couple things. One, it raises awareness around the technology. Two, I think it helps validate their interest in this. And three, it provides really important capital at a time when this sector is trying to get to commercialization and deployment. And we're very bullish on this. It's going to take 10 plus years. But, there is the potential to build not, 5 or 10 of these things. There's the potential to build hundreds of small modular reactors for everything from producing electricity to producing industrial heat. And many chemical companies and big industrial players are talking about building small modular reactors on site next to their, chemical factory or their, industrial site, because they want clean, firm power. And obviously, these AI data centers are looking for all kinds of electricity. It won't just be nuclear power, but it will also be renewables and to some degree natural gas-fired power stations. So it's all about energy addition, and we're quite bullish on this. Over time, this is going to create additional demand for uranium, and the uranium market is already in a supply deficit, and it's just going to add to the future demand, which we think will help, send out the right price and demand signals to the market to invest in more capacity.
Yeah, well said. And it's helping the public destigmatize as well, which helps. John Ciampaglia is the CEO of Sprott Asset Management, joining us now. Thanks for this, John. Very, very, very good. I appreciate you coming on and giving us some insight here.
Yeah, thanks for having me. It was an interesting discussion.
Thanks, John. Appreciate it. I'm Jeremy Szafron. For all of us here at Kitco Mining, stay tuned. We got great stories coming up. We'll see you next time.